Hi guys, hope you all are doing well. We are back with our second class for YT Mastery Classes Volume 2, and that is we are going to be completing the chapter number 2, the basic income tax computation, and also start off with our chapter 3, investment income, wherein we are going to complete that and then head on towards corporation tax for the day. Loss relief for an individual and for a company. If in case it's incomplete today, we are going to complete it by the next class. And if in case we have certain time, then if the time permits, we are going to complete that part also. So let's get started without wasting any time. Now guys, last class actually we did all this part wherein we had to calculate the basic format. As per the basic format, we had to allocate the incomes to non-savings income, savings income, and dividend income. Non-savings income is the part which is covered in this chapter. Savings and dividend income is covered in the next chapter. In this, yesterday, the last part that we solved was regarding the child benefit charge, child benefit tax charge. Yes, child benefit tax charge. We did a sum on the same wherein I showed you the calculation. But the only thing is that we actually included the net amount, right? Because the paid amount is £2,000. So we have to deduct the gross amount. I thought this is the gross amount. So the only difference is that when we resolve this sum, I'll show you how it is supposed to be done. So the income of Gisela was 60,000, right? And to calculate her adjusted income, adjusted net income, we actually deducted this amount of 2000. Rather, we had to deduct the gross amount. And that gross amount is calculated as she paid 2000 towards the gift aid donations. So it should be multiplied by 100 divided by 80 because 20 is contributed by HMRC on her behalf. And she gets a deduction while calculation of ANI of 100%. So it is going to be 2000 into 100 divided by 80, which gets her to a deduction of 2500, because of which her adjusted net income becomes 67,500. Sorry, 57,500, right? Her adjusted net income becomes 57,500 and it is still above the threshold of 50,000 and is the reason why the formula that we apply for the child benefit tax charge is 57,500 minus 50,000 divided by 100, the whole thing as a percentage, right? So we simply calculate it as 7,500 divided by 100, which gives us 75% on the tax charge. Correct? And thus, the value of the tax charge will be 7500 divided by 100. So you get it to be 75%. Okay. Now, she has got a benefit of the child of 1100 pounds. But since her income is above the threshold, she will have to repay that benefit in the form of tax charge. And she will not have to repay the whole amount. She will just have to repay 75% of it. Okay, guys. So, yeah. So here our child benefit is 1100 and from that she has to repay 75%, which will be included in the tax liability directly, and that is going to be 825. Okay. Now let us compute the tax liability. So for computing the tax liability, Gisela you can see in this question has taxable trading profits of 60,000 pounds. Okay. That is all which is required. Gisela has trading profits of 60,000 pounds. The first thing that will be deducted from her income is the personal allowance of 12,570. And thus her taxable income becomes 47,430. Correct? Now on this taxable income, she will be liable for the tax amount, and that we are going to calculate the tax liability. But always remember guys that the band is extended by not the net amount but the gross amount. So the band will be extended by 2,500 because that is the gross amount of the charity donation, of the gift aid donation that she has made. Okay. So my band goes from 0 to 37,700, but it will rather now go from 0 to 37,700. Rather than that, 37,700 plus 2,500. So the band will be extended to 40,200, and from 40,200 it will be extended to 150 to 500 because I added 2,500 here also and to 1,50,000 also, right? So now her income is 47,430. So on the first 40,200, she will be charged 20% tax liability, and that will give her a value of 8040. And on the remainder, that is 47,430 minus 40,200, she will be charged 40% tax. So thus her tax liability will be in total. Okay, before doing the total to this tax liability, guys, we will also add the child benefit tax charge. And that is going to be nothing but 825, which we calculated earlier, right? So our total tax liability of Gisela is going to be 11,757. I hope start to end the sum was clear. It is a very basic sum, guys. The only thing is that we made a small mistake last time wherein we took the net amount which she paid rather than the gross amount, and that is because we did not see whether it is the gross amount paid or the net amount paid. Okay. Now, the last part of this chapter is the residency test. It is very important for a person to have the residency test to ensure that the person is a resident in UK or not, because if he is a resident in UK, then he will be taxed on his UK and also the worldwide overseas income. And if in case he is not a resident in UK, then only the income that he is generating in UK, that will be taxed for him during the tax year. Okay. So in the tax year, you have to identify whether the person is a resident or not. And obviously for every tax year, you shall ensure that the person should be a resident. Okay. So there are three different types of tests that you are supposed to do. Let us get into the details of it. The tax residency status of an individual determines how much income is assessed to UK tax. All persons resident in UK for the tax purposes are assessed to UK tax on their worldwide income. Okay. Now, what is the definition of residence? An individual is a resident in the tax year if he or she does not meet the automatic non-UK residency test. Okay. So there is a test which if you fulfill those tests, then you will automatically be a non-UK resident. And if you do not fulfill those tests, then you will have to go forward to identify if you are a resident. Okay. So there is a non-UK residency test automatically. And if you meet those tests, then obviously you will be a non-UK resident automatically. Okay. And if in case you do not meet that automatic non-UK residency test, then you will go further to the automatic UK residency test. Okay. And lastly, if in case if that also does not suffice to identify the status or the residential status of an individual, then in such a case you will see one or more ties. Okay. Now what are those ties and everything? You'll understand one by one. Okay. So always you shall start with step 1, wherein we have to see that whether the person is automatic non-UK resident or not. Then if in case he is not a automatic non-UK resident, then in such a case we jump to step 2 to identify if he is an automatic UK resident. And lastly, if none of the automatic ties are met, then we'll go to the step 3, wherein there are a couple of other ties that we are supposed to look at. Okay, let us see firstly the automatically non-UK resident. Okay, so if any of these conditions are met, any one of these conditions are met, the person will directly be considered as a non-UK resident. Okay, the person will automatically be considered as a non-UK resident. Okay, so an individual is automatically non-UK resident if he or she is in the UK in the tax year for less than 16 days. If in the tax year, that is the tax year starting from 6th April and ending at 5th April, if during this tax year the person is in UK for less than 16 days, then he is automatically a non-UK resident. Okay. If he is less than 46 days and has not been UK resident in any of the previous three tax years. If he has been a non-UK resident, that means he never was a resident in UK in the previous three tax years also, right? And in this year, he stayed for 46 days. Okay. In this year, he stayed for less than 46. I'll keep it 45. Okay. He stayed for less than 46 days, that is 45 days. Then in such a case, he will still be considered automatically non-UK resident. Okay. Because in the previous three tax years, he has not been a UK resident. So obviously, it may be that he has just come for a long weekend or possibly he has just come for some work and always he leaves within the specified time period. Then comes the next part, that 91 working days and works full time overseas. So that he has been in UK for less than 91 days and works full time overseas, not in UK. He works full time overseas, not in UK. Then he can stay up to 91 days and he should not be considered as a resident of UK thereon. So any of those tests are met, he will directly be considered as a non-UK resident. And if none of them are met, then we'll go to the automatic UK residency test. Okay. So the automatic UK residency test, guys, says that first one, he or she is in the UK for at least 183 days. If they stay for at least 183 days in the tax year, irrespective of the fact that they have been in the previous year a resident or not, they will directly be considered as a UK resident. Okay? They will directly be considered as a UK resident if they stay for 183 days or more. If his or her only home is in the UK, that means if in case he has just one home and that is in UK, then he'll automatically be considered as a UK resident. Okay? And the last one, he or she works full time in the UK. So if in case they work full time in UK rather than overseas, then in such a case they will be considered automatically as a UK resident. Any of these three tests, if they meet, they will be considered automatically a UK resident. But before considering these ties, always you shall go in the format. You shall first look at these ties. Okay? Because guys, what happens is, if in case in the previous three tax years, okay, I was a UK resident, okay, but in this year, I stayed only for 16 days, okay. So even though in the previous three tax years, I was a UK resident, only 16 days I've stayed for, correct? So that it doesn't matter if I was a UK resident in the previous three tax years or not. In this year, I've just stayed for 16 days and my only home is in UK, right? My only home is in UK. So in such a case, guys, always remember, if in case my only home is in UK, so it means the automatic UK residency test that his only home is in UK, correct? But before considering this UK residency test, we have to check the automatic non-UK residency test, correct? And it is meeting one of this test that he has stayed only for 16 days. I'll keep it 15 because it should be less than 16, correct? He has stayed only for 15 days. So for this tax year, he will not be considered as a UK resident, even though his only home is in UK. That is because first he meets this tie. That means from this tie itself, he is a non-UK resident. Okay. Okay. Now, if any of the automatic tests are not met, like he cannot be determined automatically a non-UK resident, neither can he be determined automatically a UK resident, then in such a case, we will jump on the ties. Now, what does the ties say? That these are the five ties out of which some of them should be met depending on, I'll show you what it does depend on. Okay, so let us look at these 5 ties first. First one is family. Has a close family, that is either a wife or a spouse, a husband, civil partner, or minor children, is in UK. Right? That means if he has family in UK, then this tie is met. Accommodation. Has a house in the UK, which is made use of during the tax year. He has a house in UK and he has to make use of it during the tax year. Even for one day, he has to make use for it. Okay. So then accommodation tie will be met. Work. Does substantive work in the UK. That means most of his work is done in UK. So then in such a case, his work tie will also be met. Days in UK. He has spent more than 90 days in UK in either or both of the previous 2 tax years. Okay. So that means if in case the tax year that we are considering is 2020 to 23, his previous 2 tax years are 2021, 22 and 2020-2021. Correct? These are his previous 2 tax years. In either of these tax years or both of these tax years, any tax year in consideration, if he has stayed for 90 days in any of these tax years or both of these tax years, previous 2 tax years, then he will be considered as having days in UK. I mean, this tie will be met. Lastly, country. Spends time in UK than in any other country in the tax year. That means maybe for the tax year 2022-23, he has stayed for 200 days in UK. For 100 days in US. For 65 days in India. So that means during the tax year, for the most days, he stayed in UK. So then his country tie will also be met. Okay, technically it should not be 200 because then automatically he will be considered as a UK resident. I'll make it simpler. So maybe, he has stayed in UK for 50 days. And I would say in other countries, he has stayed for only 30 days in each country. Okay. In other countries, he visited other countries also. But in other countries, he did not stay for more than 30 days in each of those countries. So the maximum that he has stayed is he stayed in UK for 50 days. So then his country tie will also be met. Okay. Okay. Now, this part is not important. Yes. Let us look at this team. Okay. So depending on his UK residency in the previous years, he has to meet the sufficient ties. Okay. Now, technically, people actually try to, escape from their residency. They don't want to become a resident of UK. Otherwise, they will be charged on their worldwide income, the UK tax. Correct. So, most of them try to actually escape from the UK residency. And is the reason why they visit for a couple of days, then leave, then visit for a couple of days, then leave. Okay. So, depending on their previously resident and not previously resident, there are certain ties. So you try and make them as much UK resident as possible, even though they don't want to be. Okay. So guys, here days in UK depends on whether the person is previously resident or not previously resident. If he was previously resident and he has stayed for less than 16 days, it does not matter if he is previously resident or not previously resident, he will automatically be a non-resident here. Okay. He will automatically be a non-resident here. Okay. So it does not matter because it is just 16 days. Correct. And if he is not previously resident, automatically non-resident anyway. Okay. If it is between 16 to 45 days. Okay. That means if it is less than 16, that means he visited only for 15 days. He is automatically a non-UK resident. Okay. But if he or she stayed for 16 to 45 days, then in such a case, he will be a resident in UK. If he is previously resident, in this year also, he will be a resident in UK if he meets 4 ties. Okay. And if he has stayed for 16 to 45 days and he is not previously resident, so he will automatically be a non-resident, right? We saw it here. Oops. Yeah. If he has stayed for less than 46 days, then he will automatically be a non-UK resident if he was not resident in the previous 3 tax years. Okay. So for this year, he will automatically be a non-UK resident, probably if he has stayed for 45 days. So 16 to 45 days, he will automatically be a non-UK resident in the previous years he was not a UK resident. Okay. Then comes 46 to 90 days. Here he has to meet 3 ties for UK residency, and so technically if he meets 3 ties, then he'll directly be a UK resident. Okay, so you have to save himself. He has to save himself from a lot of ties if in case he does not want to be a UK resident. Okay. Then for not previously resident, that he was not a previous resident in the previous years. So then in such a case, he has to meet 4 ties, and that keeps on going down. If he is 91 to 20 days stayed in UK, then he will be resident if 2 ties are met or more. Okay. And if he was not previously resident, he has to meet 3 ties. 121 to 182 days, he has to just meet 1 UK tie. Okay. And if he was not previously resident, he has to make 2 UK ties. And lastly, if it is 183 days or more, he will automatically be a UK resident, that we already saw. Okay. So I hope this is clear, guys. Let's get started with a little bit of questions on this, which will make you clear regarding the topic. Explain whether or not the following individuals are resident in UK for the tax year 2021-22. Okay. So we'll be given a couple of situations and we have to identify whether the person is a UK resident or not. Okay. Now, Dieter was born in Germany. He has lived in his hometown in Germany until the tax year 2021-22, when he came to the UK to visit on 10th Jan 2021 until 10th June 2021 until 18th January 2022. Always remember, guys, for your days to be counted, it must have been shown somewhere. Okay, if in case it isn't, for the days to be counted in UK, you have to take the nights also, right? So technically he visited on 10th June, correct? So if he came on 10th June 2021, then in such a case he stayed the night of 10th June. So 10th June will be included while calculating the number of days, but he left on 18th Jan, right? So he left on 18th Jan. So obviously he must have not stayed the day or the night of 18th Jan. So the day of 18th Jan will not be included. Okay. So let us calculate now the number of days that he has stayed. From 10th June to 30th June, it will be 20 days. Right. 10th will also be included. So it is going to be 21 days. Then July, 31 days. August, 31 days. September, 30 days. October, 31 days. November, 30 days. December, 31 days. And lastly, in the month of January, he has stayed for 17 days. The 18th day will not be included because he did not stay the night of 18th January. Okay. So what are the total number of days? 21 plus 31 plus 31 plus 30 plus 31 plus 30 plus 31 plus 17. That will give us 222 days. Right. So he has stayed for 222 days during the tax year, and is the reason why he will automatically be a UK resident, correct? Because he has exceeded 183 days, right? He will not meet the non-UK residency test because there is nothing mentioned about it. And for the remainder of the year, he has stayed in Germany. That is irrelevant, to be honest, because here he will automatically be a UK resident, so you do not have to see the ties, okay? Now the next part, guys. Simone was born in France. She has lived in her hometown in France until the tax year 2021-22, when she came to UK to visit for a month. Okay. Okay. So this is the only situation. She has stayed in UK for 30 days, right? Or you could say 31 days. Now, Simone was born in France. She has lived in her hometown in France. Okay. That means, firstly, for the non-UK residency test, if she has stayed for 30 to 31 days, she comes in the bracket of 16 days to 45 days, correct? Now, if she has stayed for 30 days, if in the previous years she has not been a UK resident, then she can directly be determined as a non-UK resident this year, right? So she has her hometown in France and she did not visit UK until the tax year 2021-22. So what will be her residential status for 2021-22? A non-UK resident, right? She did not visit UK in the previous years, so she must have not been a UK resident in the previous years. And this year, she stayed in the 16 to 45 days range. So that is why she will be considered directly as a non-UK resident. Okay. Now the last question to understand the UK ties. Okay. Fred has always spent more than 300 days in UK and has therefore been UK resident. Okay. So that means previously he was a UK resident. He gave up work on 5th April 2021 and on 18th May 2021 he set off on a round the world holiday. So that means he actually left for a worldwide trip. He did not return to UK. So that means he was in UK from 5th April 2021 to 18th May 2021 during the tax year. Correct? He gave up work on 5th April. Correct? Our tax year starts. He gave up work on 5th April 2021 and on 18th May 2021 he set off on a round the world holiday. What do we have to identify? For which year? In the tax year 2021-22, correct? So his tax year starts from 6th April 2021. Okay, his tax year starts from 6th April 2021. Now, from 6th April 2021 to 18th May, he gave up work on 5th April and he was in UK till 18th May. After that, he went on a world trip. Okay. So guys, from 6th April to 18th May, how many days are that? 24 days of April. Yes, 24 days. Sorry, it will be 25, correct? Because 6th April is also included, right? So 25 days of April and 18 days of May. Sorry, it will be 17, correct? Because we do not include the 18th day. So 25 plus 17, the total number of days that he has stayed for in UK is 42 days. Okay, that means he is in the bracket 16 to 45 days and he is previously UK resident. Okay, now if he is previously UK resident, he does not meet the non-UK residency test and he will not meet the automatically UK residency test also. So technically, because he does not have only house or anything, right? That we will see later. So if right now we are assuming that mostly we have to go towards the ties. Okay. Now, initially he spent 5 weeks in his second home in Portugal. Okay. So 5 weeks in Portugal, that means 35 days he stayed in Portugal. Okay. But then did not spend more than 10 days in any other country whilst he was away. That means in the other countries, he stayed not for more than 10 days. Right? Whilst he was away, he kept in touch with his wife and young children who remained in the family home in UK. Right? So technically he was in touch with his wife and children which are in UK. Right? So you can see a couple of ties meeting here. Correct? The first tie that is meeting here is that, guys, he has stayed in UK for 42 days and in Portugal he stayed for 35 and in other countries only for 10 days. That means firstly he is meeting the country tie because for the most phase in the tax year he has stayed in UK, correct? As compared to staying in other countries, right? So firstly let us look at how many ties he has to meet. He was previously resident and he has stayed in this days gap, that is between 16 to 45 days. So he has to meet 4 UK ties. Okay. So firstly he meets the first UK tie, that is country, the second UK tie, that is family, right? Who remain in the family home, right? And obviously his family tie will be met. Where is his family? Yeah, because his spouse and children are at home. He also meets the accommodation tie because he has a home in UK and obviously he was in UK for 42 days. So that time obviously he was staying at his home because they have not specified that he was staying anywhere else, right? So that means his accommodation tie is also met. His work was also in UK because he used to do substantive work for a period of time, right? His work was also in UK, so that means 4 ties are any which ways met. And days in UK is also met because in the previous years, obviously, he was a UK resident. He was staying in UK, so he must have met at least, he must have stayed for at least 90 days in the previous 2 tax years. So technically, all the UK ties are met, and obviously, he will be considered as a UK resident for this year also. Okay. So I hope this part is clear, guys. With this, we come to an end of our this chapter, that is chapter number 2. We will quickly start with chapter number 3, that is our investment income. But before that, we take a short break of 10 minutes and then actually we'll take it for 15 minutes and then we'll return with the new chapter, that is chapter number 3. So it is 9:47 right now. We meet by 10:03. Okay. Okay, guys, sorry for being late. Let's get started with a new chapter, that is investment income. Okay, so investment income, guys, always remember includes your savings income and your dividend income. Okay, and your other income is nothing but savings income, dividend income, and your non-savings income that we have. Okay, this makes up the total income of an individual of the taxpayer. Now, if the total income of an individual or a taxpayer, maybe say his non-savings income is 10,000, his savings income is 15,000, and his dividend income is 3,000. So it is not like on each one of them there will be the lowest charge that is there. It goes like, maybe say this is the number line. Okay, from 0 to 10,000 will be his non-savings income, and again 15,000 savings income that is there, that will not start from 0, that will start from 10,000. So from 10,000 to 15,000, the another one, that will be the non-savings income. So firstly we take the savings income, then after that we take the non-savings income, and lastly we take the dividend income. Okay, that means what I'm trying to say here is that if in case his non-savings income is 30,000 and his savings income is 20,000, in total his total income is 50,000, so he's crossing the bar of 37,700. So technically, if this is the bar of 37,700, then 30,000 is his non-savings income. So on this value he will be charged 20% tax, but from here to another 20,000, that will probably be somewhere here, that will end up 50,000 here. So this is my savings income. So you can see here some part of the savings income will be charged at the basic rate band, and some part of the other savings income will be charged at higher rate band. Okay, always remember this. Even though his income is just 20,000, but after the non-savings income has been completed, after that you start your savings income. Let's get started. Now, what are the types of your savings income? As I said, it is your building society interest. That means probably if you've invested or deposited any amount in a financial institution other than a bank, it is known as building society. And the interest that you get from that is simply known as building society interest. So building society interest and bank interest, these are the two things from which you earn an interest income, and that will be considered as your savings income. Okay, that is bank interest income and building society interest. Other sources of income include interest from NSI, that means National Savings and Investment Certificate, but obviously these are exempt. These are exempt interests that you receive. Okay, including both NSI investment accounts and NSI direct saver accounts. So there are two types of accounts. There is investment accounts and direct saver accounts. So both of the accounts, wherever you get interest from, that is an exempt interest. Interest from gilt-edged securities. Gilt-edged securities are nothing but shortly known as gilts, or you can also say these are government bonds. Okay, so if in case the government wants to raise certain capital for government spending or something, government also issues certain bonds, and they issue bonds at a very comparatively low interest rate, but it is risk free because the government is obviously going to repay you everything. Okay, and it is known as treasury stock. So the government bonds are known as treasury stock or exchequer stock. Okay, it is known as treasury stock and exchequer stock. These are usually the stocks which are issued by the government. Okay, interest from quoted company loan stock. If in case I have purchased certain loan notes. Loan notes are nothing but tradable debt that is there out in the market. That means the company, instead of taking a simple bank loan, they rather take loan notes out from the market. Okay, so if in case I am purchasing the loan notes, that means I am giving them a loan for the amount of purchase, and in return they will pay me the interest and the capital repayment on the redemption. Okay, so that means I have the loan note with me, so I will earn interest on it. So those are the quoted company loan stock. Those are taxable. Okay, Interest from quoted company loan stock, also known as company bonds, debentures, or loan notes, are all taxable. Remember, income from NSI certificates and premium bond winnings are exempt. An individual is taxed on the amount of savings income received in the tax year. Okay. Savings income is usually taxed at the band 20%, 40%, and 45%. And the band is same. Till 37,700 it is 20%. Till 1 lakh 50 it is 40%. And above 1 lakh 50 it is 45%. Okay. Now, there is actually certain advantages which are provided to savings income, because usually the non-savings income is taken the first part of the basic rate band, and after that comes your your savings income, correct? So for savings income usually they reach the 40% band, and because of which they have to pay very high tax on the savings income, right? So technically there is a starting rate, and there are also advantages that are available for the non-saving for the savings income. Okay, so however, a starting rate of tax of 0% applies to all taxpayer where savings income falls into the first 5,000 pounds of the taxable income. Okay, I'll just give you an example for it. Okay, so maybe say this is the band, okay, and there is a starting rate benefit which is provided for the savings income, that is maybe till 5,000. So here I'll take 5,000. Okay, 5,000 is the starting rate band available for the savings income, but that starting rate band depends on the level of non-savings income. How it depends, I'll show you. Okay, so somewhere here must be your 37,700, right? Which is irrelevant here. I'll show you why. Maybe say your non-savings income is maybe your trading income or maybe your employment income in total are 13,200, and your savings income is 3,000. I'll take it as 3,500. Okay. Okay. Your non-savings income is 13,200 and your savings income is 3,500. Okay. Firstly, you will deduct the personal allowance from the non-savings income, because always you shall deduct first from the non-savings income, then the savings income, and then lastly, if there is still unrelieved personal allowance, then you can claim it against your dividend income. Okay. So here my non-savings income is 13,200. From this, the first thing that will be deducted is personal allowance of 12,570. Correct? So what is the remainder? 13,200 minus 12,570, which is going to give me 630. Right? So my taxable non-savings income is 630. Correct? Now it is just 630, guys. Right? It is just 630. That means it is less than 5,000. Right? So from 0 to 630 somewhere here, only this part is my non-savings income. Right? Only this part is my non-savings income. So the remainder is available till 5,000 for my savings income. Okay. So what is that? 630 is occupied by the non-savings income. Right? 630 is occupied by the non-savings income. I'll just rewrite this. So the remainder is 5,000 minus 630. 5,000 minus 630, which gives me 4,370. So guys, always remember, till the amount of 4,370, okay, if in case my non-savings income, my savings income are less than 4,370, then on that 0% tax charge will be there. Okay, because it is not exceeding the limit of 5,000, right? 4,370 will make me reach here, but technically my savings income are only till here, that is it is 3,500. Correct? So that means it is within the starting rate band of 5,000. So is the reason why I am going to take 3,500 at 0% tax. So the only tax that I am going to pay is on the 630, the 20% tax for the non-savings income. that is 126. Always remember this, guys. Okay. So if in case maybe say my non-savings income are rather 15,300. Okay. My non-savings income are 15,300. This is my band. Somewhere here my 5,000 is there, right? And my savings income, guys, is actually 3,200. Okay. So my non-savings income, from that, firstly I'll deduct the personal allowance of 12,570. Correct? I'll firstly deduct the personal allowance, which will give me 15,300 minus 12,570. That is 2730. So from 0 to 2730, this part has been occupied by my non-savings income, right? 2730, and I have the limit up to 5,000, correct? For the starting rate 0% tax, out of which 2730 is already occupied by the non-savings income. So 5,000 minus 2730, the remainder is 2270. So up to 2270, that is from this amount to this amount of my savings income, 0% tax charge will be there. Okay. From my non-savings income to 5,000, it will be 0%. But now my total savings income is 3,200, correct? So maybe it is exceeding 5,000 also somewhat, right? So that means my non-savings income, out of that on 2270, there will be 0% tax. 2270, it will be at 0% tax, right? So the remainder 3,200 minus 2270, on the 930 of the savings income, I will be charged the tax, and obviously it is within the first basic rate band of 37,700, so it will be charged at 20%. Okay, so 930 into 20%, that will get me 186. Also on the savings income, on the non-savings income of 2730, there will be 20% tax charge, that is 2730 into 20%, that is 546. Okay, so 186 plus 546, this is the only tax liability for me. I hope start to end it was clear, guys. This was the starting rate explanation of your not of your savings income. Okay, now one more thing, that is the savings income nil rate band. Okay, guys, the savings income nil rate band. So what happens is, maybe say that my non-savings income is 35,000. Okay, if my non-savings income is 35,000 and my savings income is 2,200. Okay, so what is my taxable total income? It is going to be 35,000 plus 2,200, and obviously we'll deduct the PA from it. So that will be 37,200 minus 12,570, which will give me a taxable income of 24,630 pounds. Okay, so my taxable income becomes 24,630 pounds. That means my 37,700 bar is here. So it is obviously below the total bar, that is 24,630. Right. So how will it be taxed? Firstly, on the non-savings income, it is nothing but 35,000 minus 12,570. That is 22,430, right? Because I deducted the personal allowance, and this will be charged at 20% tax. That is 4,486. Now for the savings income, if in case the taxpayer, if in case the savings income fall within the basic rate band, okay, if in case my savings income fall within the basic rate band, obviously it is within the basic rate band, then in such a case, I will get £1,000 0% tax band. Okay. So on £1,000, I will have to pay 0% tax, and the total savings income is 2,200. So from that, on 1,000, I've already taxed 0%. So on the remainder 1,200, I will tax the 20% basic rate. That is going to be 240. Okay. But for this to be claimed, always remember that I should be a basic rate taxpayer. Here, my income is less than 37,700, so that means I'm a basic rate taxpayer. Okay, so the savings income nil rate band is for a basic rate taxpayer, it is £1,000. And if in case I'm a higher rate taxpayer, it is £500. And if in case my income exceeds £1,50,000, so then in such a case, I will get no nil rate band. So there is a starting rate band for that 5,001 that I explained, and separately there is a nil rate band depending on whether I'm a basic rate taxpayer or a higher rate taxpayer. Okay. So the tax rules apply same 20, 40 and 45%, and the limits are also the same. But note that there is basic, if he is a basic rate taxpayer, he will get a nil rate band on his savings income up to £1,000, and if he is a higher rate taxpayer, he will get a nil rate band of £500 on his savings income. Okay. Savings income is taxed as the next slice after non-savings income. As I told you, first non-savings income will occupy the part, then from there the savings income will start. Okay. Therefore, the following steps shall be followed. Calculate the income tax on non-savings income. Apply the different rules of the tax on savings income in the following order. Then you have to apply these rules, right? And eventually you'll get your answer. So starting rate, I've already explained you guys what this is. We don't need to go through it again. Yes, the nil rate band. If there is further savings income to tax, consider the savings income nil rate band. If the taxpayer is a basic rate taxpayer, the next £1,000 fall in the savings income nil rate band and is charged at 0%. And if the taxpayer is a higher rate taxpayer, then he will get a nil rate band of £500. Okay, and if he is an additional rate taxpayer, that means his income is more than £1,50,000, then in such a case, obviously, he will not be getting any sort of nil rate band. Okay. Okay, we don't need to go through this because we already know of it. Yes. So this is the pro forma that we can use for the sake of simplicity in the examination to understand the whole full-fledged sum. So this is the total of your savings income, the trading income, employment income, pension income, property income. Then comes your savings income that is dealt with separately. You can see here the dividend income that is dealt with separately. Okay. And obviously you will total all of this and you will get your total income. From this, you will deduct all the reliefs that are there available for the non-savings income, for the savings income, and for the dividend income. Obviously, there are no reliefs for dividend income. Net income will thus be the remainder of the amount. From that, firstly, you will deduct the personal allowance for the from the non-savings income. If there is any personal allowance which is not claimed yet, even after deducting the whole non-savings income, then the personal allowance shall be deducted from here, then here, then here. Okay, and lastly, we will get our taxable income. Okay, as I told you, first the personal allowance shall be deducted from the non-savings income, then from the savings income, and lastly from the dividend income. Okay, let us do this sum. This will probably give you more clarity on how to actually deal with the questions. Okay, yes, we can do this. Actually, we'll do this one. Okay, this will give us more clarity. Just give me 1 minute, guys. Yes, I'm so sorry. Let's get started. Okay, guys. Now, Jamie has received bank interest of 3350 pounds during the tax year 2021-22. Calculate Jamie's income tax payable assuming he also had employment income and payee deductions in the tax year 2021-22 of the following. Okay. So he has an employment income of 25,000, of 47,500 and of 16,100, and his payees are also mentioned here. Okay. So let's get started. So guys, firstly, for Jamie, he has an employment income, right? So I'll make a bar for his non-savings income, for his savings income, and the total income, right? So his income is how much, guys? 25,000 as per the first scenario. So I'll write here 25,000. His savings income is always been 3350. Received bank interest during the tax year 3350. So technically his savings income 3350. So the total is 25,000 and here it is 3350. So his total income is 28,350. Right? It is 28,350. Now firstly we will deduct the personal allowance, that is 12,570. And thus my taxable income will become 15,780. Taxable income is 15,780. Right, guys? So now let us calculate the tax liability. So the tax liability will simply go as, firstly, from 0 to 37,700, I have an income of 12,430, right? For my non-savings income. And on that 20% tax charge will be there. So my tax charge is going to be 2486. Correct, guys? My tax charge is 2486. There will not be given any starting rate band because obviously my non-savings income is above 5,000. Okay, if it is below 5,000, the remainder up to 5,000 can be taken as 0% tax using the starting rate. But here my non-savings income is exceeding 5,000, so obviously there is no starting rate applicable. But still, guys, I am a basic rate taxpayer because my income is less than 37,700. Right? So how will my tax liability will be calculated? Now, for my savings income, the total is 3350. On the first 1,000, I will be charged at 0% tax, right? So, technically, here it will be 0, right? And for the other savings income, that is 3350 minus 1,000, on that obviously 20% tax charge will be there, which will give me 2350 into 20%, that is 470. And thus the total tax liability for me is simply going to be 2956. Okay. The total tax liability is going to be 2956. Now obviously guys, I have a pay of 2630, right? That means I've already paid a certain amount as pay. So that pay will be deducted. This is my tax liability. From that, the pay as you earn will be deducted, which is 2630. And we will be getting the tax, which is actually payable, which will give me 326. So I hope you all have understood the sum start to end. If in case any doubts, you all can directly ask me in the comment section. Let us move to the second one, 47,500 for Jamie. There is his non-savings income, there is his savings income, and the total income, right? So first, guys, what will be considered? His employment income, that is there. His employment income is how much? 47,500 pounds. Then he has savings income of the whole year. It is, I mean, for all of the situations, it is 3350 only, right? So now his total income will become 47,500 plus 3350, and the total will be 5850, right? The first thing that will be deducted from this, guys, is the personal allowance. So the personal allowance will be 12,570, that will be deducted, and thus his taxable income will be jumping to 34,930, 3350, and 38,280, right? His taxable income will fall to 38,280. Now here there is a little bit tricky, so just focus, guys. If in case you all do not find it tricky, well and good, but if you all don't focus correctly, then you might be confused with it. Okay, so let us firstly calculate the non-savings income. My non-savings income is 34,930, correct? So on that, I will first charge 20% tax. That will be 34,930 into 20% tax, which is going to give me 6,986. Now guys, always remember here, I am not a basic rate taxpayer because my income is exceeding 37,700. That means I'm just a higher rate taxpayer. Okay, my limit is 37,700. If I exceed that, I will be considered as a higher rate taxpayer. And here it is 38,280. That means I'm a higher rate taxpayer. So guys, if in case I'm a higher rate taxpayer, my savings income that will be considered is, firstly on the 500, I will get 0% tax, right? The starting rate band. Because I'm a higher rate taxpayer, I will only get it on 500. Okay. And on the remainder of the savings income, just focus here, it will still be divided in two parts, the savings income. How? That I'll show you. Okay. Maybe see, this is your band. Okay. Wherein 37,700 is somewhere here, but your total income is 38,280. Okay, your total income is 38,280, correct? That means till 34,930, guys, till 34,930, till 34,930 is my non-savings income. That means somewhere around here, 34,930, till here my non-savings income is concluded, right? Then from here my savings income will start. 500 of the savings income is taken, right? 500 of the savings income is taken. So that means my savings income is how much? Technically my band is 37,700. Okay. From that, 34,930 has been occupied by the non-savings income that I told you. 500 more has been occupied by the nil rate band of the savings income. So only the remainder of the savings income can be taken at 20%, because after 37,700, the remainder of the amount that will be taken at 40% because it is exceeding 37,700. So it will be 37,700 minus 34,930 minus 500. That will give me 2270. So 2270 will be charged at 20%. That will give me 454, right? And on the remainder of the savings income, that is 38,280 minus 37,700. that is 580. On that you will be charging 40% tax, right? So my total income tax liability will thus be 7672, correct? This is my total income tax liability. From this, obviously the PAYE will be deducted, and that is for this question provided to be 6530, correct? So 6530 I've already paid for the tax. So technically the remainder amount which is to be paid is 1142. That is my tax payable. Okay. I hope that is clear, guys, to one and all. If there are any other doubts, you all can ask me directly on the comment section. Okay. Solving the last part of the sum, and then remainder of the sums I think you all can deal with it by yourself, because it is very straightforward and easy. Okay, let's get started. Lastly, his employment income is 16,100 pounds. Non-savings income, savings income, and total income. Right? So here, firstly, we will take his employment income, which is 16,100, correct? Here you can see. And his savings income is the same, that is 3350. So his total income will become 19,450, correct? Now from this, the first thing that will be deducted is personal allowance of 12,570, and here also it will be deducted 12,570. So the total taxable income is going to be just 6880, in which the non-savings income is just 3530. So this is a question on the starting rate band, guys. Focus. Okay. Firstly, on my non-savings income, I will charge on 3530 20% tax, and that will give me 706. On my savings income, see, now this is a starting rate band scenario. If this is my band starting from 0, and here somewhere is my 5,000, okay, out of which 3530 is already taken by the non-savings income, right? This part may be till here 3530, it is already taken by the savings income, sorry, non-savings income, but my non-savings income is still falling short of 5,000, correct? So the remainder of the value that can be considered as my savings income starting rate band, correct? So from 3530 to 5,000, that is 5,000 minus 3530, 1570 worth, 1470 worth of income is going to be charged at 0%. That is known as my starting rate band. Then I will also be having my nil rate band for the savings income. That is going to be simply for 1,000, right? So on 1,000 also I will charge 0%. So it will technically be 00. Lastly, on the remainder of the savings income, the basic rate band will be charged. My total savings income is 3350, from which on 1470 the starting rate is charged 0%, and on 1000 the nil rate band has been charged. So the remainder is 880, and on that 880 I will charge 20% tax on the savings income. So it will simply be 880 into 20%, that is going to give me 176. So the total income tax liability for me is going to be 882, and from which pay is 850. So pay as you earn is going to be deducted of 850, and the remainder simply is going to be my income tax liability for the year. That is, sorry, income tax payable. That is going to be 32, and tax liability is going to be 882. Okay. I hope start to end it was clear to you guys. If there are any further doubts regarding the same, you all can directly mention it to me on the comment section. Okay, guys. Let us continue with the remainder. Okay. Now we understand dividend income. So, guys, as I told you, dividend income is taken into consideration after your non-savings income and your savings income. So, if my non-savings income is 30,000, the first 30,000 will be taken over by the non-savings income, right? The next maybe say my next savings income is there. So from 30,000, maybe say till another 10,000 is there. I'll write it here. Another 10,000 is there. That is my savings income. And after that, last will come into existence my dividend income, which is maybe say 3,000. Okay. That is how we are supposed to deal with it. Now, always remember for dividend income, there is a nil rate band available. That means on this much amount of dividend income, there will be 0% tax, and that is 2,000 pounds. Okay, that is 2,000 pounds. If in case it exceeds 2,000 pounds, then the basic rate and the higher rate and the additional rate tax will be charged on it. Always remember. And this 2,000 pounds, it does not matter if you're a basic rate taxpayer or a higher rate taxpayer or an additional rate taxpayer. Everyone will get 2,000 pounds worth of deduction on their dividend income. Okay. After that, if in case there is any additional dividend income and which is falling within the 37,700, then in such a case 8.75% is the interest is the tax charged on it. If it is between 37,701 to 1,50,000, then 33.75% will be charged. And if there is an additional rate taxpayer, that means the dividend income is 1,50,000. Okay, maybe say 1,50,000 is somewhere here. Okay, till 1,50,000 I have my non-savings and my savings income only. So the dividend income will start only from the 1,50,000 amount. Correct. So on that the maximum rate will be chargeable. Correct, because the dividend income is starting only from the additional rate tax paying. Right. So on the first 2,000 it will be exempt on the first 2,000 pounds. But if the dividend income is 5,000 pounds in total, so for 2,000 it is 0% tax, but for the remainder 3,000, since my dividend income is falling in the additional rate tax band, 39.35% will be charged on it. Okay. I hope start to end it was clear, guys. If you have any further doubts, you can let me know regarding the same. I think we have done all this. You don't need to go through all that. We will just solve this one full-fledged sum and call it a day. Then we have certain other theoretical sums a little bit that I'll explain you. Yes. Let us do this last sum. Okay, guys. So Susan has the following income and outgoings for the tax year 2021-22, and her trading income is 11,615, employment income is 13,500, the bank interest that she has received is 3,500, her dividend income received is 2,000, and she has paid certain qualifying interest. Qualifying interest, guys, always remember it shall be deducted as a relief before taking into consideration the personal allowance. Okay, so guys, let us calculate that what will go where, whether what is in my non-savings head, what is in my savings income head. Okay. So, firstly, my non-savings income and my savings income. Then my dividend income is also there here. And lastly, my total income, right? Firstly, I have an employment income, 13,500. Also, I have a trading income of 11,615. Employment income 13,500. Trading income 11,615. Then comes the latter part, that is bank interest which is received, right? That is my savings income 3,500. And lastly, I have a dividend income which is received. Oops, that is 2,000, right? Dividend income which is 2,000. So my total income will thus be 30,615, right? My total income will thus be 30,615. Now from this total income, guys, the first thing that I deduct is my personal allowance, that is 12,570. Sorry, before deducting personal allowance, we have a qualifying interest paid, right? Qualifying interest paid is 1,000, so that will be deducted. Less reliefs of 1,000 is going to be deducted. Obviously, interest paid will be related to my non-savings income, correct? And 1,000 will be deducted here. So, the total income, the net income that is there, that will be this. Now, from this, the personal allowance will first be deducted, that is 12,570. And thus, the taxable income that I will get, that is 17,045, that is 11,545 plus 3,500 plus 2,000. Okay. Now let us compute the income tax liability. Okay. Now guys, first thing, I have my non-savings income, that is 11,545. On that 20% tax charge will be there. So it will be 11,545 into 20%, 2,309. Then comes my savings income. On the savings income, guys, always remember, firstly, the nil rate band will be applicable. Starting rate band will not be considered here because obviously my non-savings income is above 12,000, correct? So on this 0% tax charge will be there. Then for the next one, that is my remainder of the savings income, which is in total my savings income is 3,500, out of which 1,000 I have charged as the nil rate band on. So the remainder, oops. So the remainder is 2,500 on which I will charge 20% tax again, and I will get the answer to be 500. On the dividend income, lastly, the 2,000 worth of dividend income that is there, irrespective of if I'm a basic rate taxpayer or a higher rate taxpayer or an additional rate taxpayer, for the first 2,000 I will always get a 0% tax, and thus my tax liability here will be nil. So my total income tax liability sums up to 2809. Right? Now, my total income tax liability sums up to 2089 or something, 2809. And from that, I've also paid 330 pounds as my pay. Okay, pay, right? PAY. How much was it? 330. So the remainder will be my income tax, which is payable for the year. Okay. I hope the sum was clear start to end, guys. And I hope that the chapter is almost clear to you all. Now you all can do this sum by yourself because it is quite straightforward and simple. Let us go to a little bit of theory that is there within the individual savings account. So guys, individual savings account is where, if you invest your money or if you keep your money, there it is considered as an exempt income. And obviously it is an advantage or a benefit given by the taxable authorities and is the reason why it is not a tax evasion, but just a tax avoidance by trying to make use of the benefits which are provided or use of the privileges which are provided by the taxable authorities to a taxpayer. Okay. ISAs have an annual subscription limit, and the annual subscription limit is £20,000 per person per year. Okay. It is going to be £20,000 per person per year. That means if in case they can invest any amount. Okay. But maybe say that if I invested £30,000 this year in the ISAs. So I will get a tax-free income of only £20,000, even though I invest £30,000 in total. On the remainder £10,000, I will have to pay tax. Okay. On the remainder £10,000, even though I keep it in ISAs, I'll have to pay tax because the limit is £20,000 per person per year. Okay. So for married couples, there will be 20,000 limit for each one of them. Okay. Now, ISAs could be any stocks and shares that have been purchased. That means there are two types of ISAs. One is cash ISAs and one is your stock ISAs. Okay. The 20,000 limit is there irrespective of you want to invest in stocks or you want to invest in shares. Okay. Or you want to just keep a deposit or anything. Note that spouses and civil partners each have their own limits, as I already told you. Now, we can ignore this part, it's not required. Yes. Stocks and shares ISAs. Guys, for many individuals, the dividend nil rate ban means that investing in stocks and shares ISAs no longer provides an income tax benefit. That means probably if you're investing in the stocks and shares ISAs, your dividend and dividend nil rate band and everything will probably be lost. Okay, that is what they are saying. But it is, to be honest, irrelevant. We don't need to get into the details of it. Okay. Um, yes. Yes, let us do this full-fledged sum. Maybe you'll understand something about it through this. Okay. Ahmed sold £75,000 of 6% gilts, including accrued interest. Okay. That means they sold. Okay, guys, this one is not required, to be honest, because it is quite simple. You all can just go through it later on because this is a quite simple section. So guys, I guess with this we come to an end of this chapter because see, we do not need to get into the details of it. This is just a part of theory. Okay. So I will just explain you a brief understanding of it, that what will happen. What happens is when I purchase the gilt-edged bonds or any sort of bonds, okay, its interest accrues every year. Okay. That means I'm going to receive certain interest on it every year. Maybe say I've purchased these bonds of 75,000. Okay. 75,000 is the value of the bonds and these are 6% gilt-edged bonds. So that means I receive interest of 6% on it. So 75,000 into 6% interest, that is I receive annually £4,500 of interest on it. Okay. I receive annually £4,500 of interest on it. Now there is a date fixed. Okay. That if I have purchased the bonds on 1st Jan 2022, every year it will accrue by the year end, that is 31st December 2022, 31st December 2023, 31st December 2024. Okay. Now, whenever the interest will be received, maybe say it is a 3-year bond, every year I will receive the interest, and at the end of the third year, I will receive the capital repayment. Okay, that is the total amount will be recovered to me. But maybe before that, I intend to sell it, because what happens is, maybe say right now it is worth 75,000, but when it is near to the year end, that time I will receive interest. So people will be wanting to purchase my bonds, because if they say that, on 1st November 2022, they know that within 2 months, if I purchase it right now, within 2 months itself, I'll receive the interest on it. Correct? Because by the year end, I will receive the interest. Correct? So within 2 months, I'm going to receive the interest on this bond. So during the period of 1st November, or when it is nearing to the interest to be received, the fair value of it increases. Okay? The fair value of it increases. So technically, even though the bond would be worth 75,000, at that time people would be willing to purchase it probably at 80,000. And that is because they know that within a period of 2 months they will receive a lot of interest. So even though if they pay a little more, it's okay. Okay. So then in such a case, they will be wanting to purchase at 80,000. So what happens is, because of this, there is accruals which comes into existence. Because if in case when nearing to the interest that I'm going to receive, if I purchase the bond at the start of the year, 75,000, before that I've received the interest, I sold it at 80,000. So I earned a profit of 5,000. And at the year end, I do not even have these bonds. Okay. Technically, I'm not even having it as my savings income, because obviously I sold them. Correct. So technically I sold them. So I earned a profit here of 5,000. Correct. So if I earned a profit here of 5,000, then in such a case, guys, that is because I earned the profit because it was nearing to the interest. So I will not consider the interest, because so technically he will receive the interest. The person who purchased it at 80,000 will receive the interest, but on the interest till 1st November, he will not pay. The interest will be accrued to the other person, right? The interest will be accrued to the seller. And after 1st November, from the date when he purchased it, the interest will be accrued to him within his taxable income. That is what they are trying to say. Okay. This part is not that important, guys. If in case you have any other doubts, you can just ask me directly in the comment section. I'm not getting into the details of it, right? Okay. So I hope with this you all are pretty much clear with chapter number 3. We are also done with our chapter number 3. We are now supposed to start with an important chapter, guys. That is chapter number 14 or something, which is technically our third chapter, which is corporation tax. So let us understand corporation tax. But before that, we'll take a short break till 11:10. Okay, I mean for 10 minutes. And after 10 minutes, we're going to return with the remainder of the chapter. Guys, let's get started with the new chapter. I'll just open the new one. Okay, guys. Now we are going to head on towards chapter number 14, that is corporation tax. So we will understand that for a company, how the amounts are taxable and how the amounts can be deducted for any sort of expenses that they are incurring. So any sort of incomes that the company generates, on that they are supposed to pay corporation tax. And if in case they are generating incomes inside UK, oops. Okay. So any of the income that the company is generating, on that they have to pay the income tax, and any sort of expenses that they are incurring for the purpose of business related to trade. So in such a case, that can be claimed as a relief against the incomes that they are generating. So the corporation tax is actually going to be depending on whether the company is incorporated in UK or not. Incorporated in UK. And the second one, unincorporated in UK. Not unincorporated, not incorporated in UK. Okay. So if there is a company which is incorporated, or you can say listed to the stock exchange in UK, okay, it was incorporated in UK, then whatever are the incomes that the company are generating, not only in UK, but for its worldwide income, they will be taxable. Because technically you can say that they are a resident in UK, right? So any company which is a resident in UK is going to be taxable on its worldwide income. Whereas any company which is not incorporated in UK, or you can say not a resident in UK, then in such a case, only their incomes that are generated in UK, only that incomes will be taxable. Only those incomes will be taxable. Okay, guys. So let us understand firstly that whether the company is incorporated in UK or not. Technically, it is not about the incorporation, it is about the residency. So if the company is considered to be a resident in UK, then they will have to pay tax on their worldwide income. And if they are not a resident in UK, then in such a case, they will have to pay tax only on the incomes that they are generating in UK. Okay, so let's get started with the first basics, that is to identify whether the company is a resident in UK or not. Okay, corporation tax is assessed on the company's taxable total profits arising in an accounting period. Always remember, guys, accounting period is nothing but a period of 12 months. Okay, accounting period is a period of 12 months. That means it starts from where the company started to trade. That is, maybe the company started to trade from 1st Jan 2022, and it ends 12 months after that, that is 31st December 2022. Okay, it could also be from 1st April to 31st March, from 1st October to 30th December, depending on where the company starts the trading from. Okay, so this is one accounting period, that is from 1st January 2022 to 31st December 2022, and the next accounting period will start from 1st January 2023 and end at 31st December 2023. Okay, so this is known as the second accounting period. Whatever are the taxable total profits that they are generating for the accounting period, those will be considered for the tax assessment, for the tax liability in the year 2022, and this will be in the year 2023. Okay, the accounting period is not necessarily the same period as the company's set of accounts, that is period of accounts. That means technically the period of account that is there for a company, that can be greater than the 12-month period. Okay, so then if in case the period of account is 15 months, so the taxable authorities will consider this 15-month period in two different accounting periods, because they take into consideration only accounting periods, right? And accounting periods are of only 12 months, right? So the first 12 months will be a separate accounting period and the remainder 3 months will be a separate accounting period. Okay? Because the taxable authorities take into consideration the accounting period and the profits which are arising during the accounting period. So in this 12 months, whatever are the profits arising, that will be separately taxable under the accounting period, and this will be separately taxable under the second accounting period. Okay? It is important when dealing with the corporation tax to understand the terms period of account and accounting period. As I have already told you, a period of account is any period for which a company prepares accounts. The company could prepare accounts for a 15-month period also, but it is usually 12 months only in length. It can also be shorter or longer than this. Okay. So that is known as period of account. I'm so sorry. I think I went directly to the last slide. Okay. When does an accounting period start? As I told you, the accounting period is the 12-month period. Okay, it is fixed 12 months. When a company starts to trade or receives income chargeable to corporation tax and when the previous accounting period ends. Okay, so technically, maybe my previous accounting period ended on 31st Jan 2022. So the next accounting period will start from 1st Feb 2022. That I've already explained you, correct? And when does an accounting period end? It ends 12 months after the beginning of the accounting period. That means my accounting period began from 1st Feb. So it will end at 31st Jan again in the year 2023. Okay. It is a 12-month period that we have taken into consideration. I hope it is clear, guys. When does the accounting period start and when does it end? Okay. Now this is not relevant. Yeah. So as I told you guys, for a long period of account, maybe say I have prepared the accounts from 1st April 2022 to 31st October 2023. So from 1st April 2022 to 31st October 2023, this is known as my period of account. Okay, this is known as my period of account, guys, and this is a more than 12-month period, correct? So that means from 1st April 2023, sorry, 2022 to 31st March 2023, this is a 12-month period. This will firstly be considered as a 12-month accounting period. And from 1st April 2023 to 31st October 2023, which is April, May, June, July, August, September, October, which is another 7 months period. So that 7 months period will be the 7 months accounting period. So the first accounting period will be 12 months and the second accounting period will be 7 months. That is how it will be divided. Okay, guys. So the period of account could be longer, but the accounting period cannot be longer than 12 months. It should be exactly 12 months. So the first period, it should be subdivided into 2 accounting periods. That is first period of 12 months and the second period of the remainder of the months. Okay. I've already explained you this, so it is not required. Okay. Now guys, your tax year and everything forget here. The tax year which starts from 6th April ends at 5th April, that is not relevant here. Here the financial year comes into existence and the financial year starts from 1st April 2022, maybe it starts at, and it will end at 31st March 2023. This is your financial year. Okay. And it is better off for a company to align their financial statements, their year ends with the financial year, because most of the time the company might not have an aligned financial statements, correct? They might have an accounting period ending 31st December they might have an accounting period ending 31st October. So it is not aligning with the financial year, correct? So the financial year starts from 1st April and ends at 31st March. For the sake of simplicity, it is better off for a company to actually correspond their accounting period with the financial year. Okay. So now guys, my financial year, this will be considered as the financial year 2022 because, oops, it will be considered as a financial year 2022 because it has started on 2022 and ended at 31st March 2023. For an owner managed company, okay, alignment with the income tax year, the odd 5 days can be ignored, right? Because if in case there is a single person, okay, there is only just one owner, okay, and he's also the manager, or you can say he is himself managing the whole company. But at the end of the day, it is a company. Okay. So for companies, you have to ignore those odd 5 days. You have to take 1st April to 31st March only. It makes it easier to calculate the most tax efficient method of extracting profits from the company of individual owners. That means it is a solely owned company by a single individual, right? Now, you have to personally determine, as I told you, that whether the company is a resident in UK or not. Because if the company is a resident in UK, the company will have to pay corporation tax on all of its income that they are generating from the world, throughout the world. And if in case they are not a resident in UK, then they will just have to pay income tax on their incomes being generated in UK, right? So firstly, let us see what are the tests. There is for corporation tax, it is very simple. There is just one or two tests that you're supposed to look at for identifying whether the company is a resident in UK or not a resident in. Okay. So companies resident in UK are chargeable to corporation tax on all profits, as I told you, wherever they arise. And that is why it is important to identify whether the company is a resident in UK or not. So for determining the residence, there is just 2 points that you're supposed to note. It is incorporated in UK, or if in case it is incorporated in some other country, maybe it is incorporated in Japan. Okay. If it is incorporated elsewhere, but it is centrally managed and controlled in the UK. That means that company is incorporated in Japan, but most of its functioning, most of its role play is done in UK. That means maybe most of its board of directors are in UK. Their annual general meetings are held in UK. Maybe their monthly meetings are held in UK. So that means it is incorporated outside UK, but it is still centrally managed and controlled in UK. Then in such a case, it will still be considered as a resident in UK. So the company could either be incorporated in UK, and if it is incorporated in UK, it does not matter whether it is centrally managed in UK or centrally managed elsewhere. If it is incorporated, it will be a UK resident. But if it is incorporated elsewhere and centrally managed in UK, then it will be considered as a UK resident also. Okay, guys? You can ignore this part. This will confuse you a little bit. Let us solve this simple sum and identify whether the company is a UK resident or not. Okay. Now, Mill Limited is incorporated in France but holds all of its board meetings in Germany. Okay. So this company is incorporated overseas because it is not incorporated in UK, it is incorporated in France. And its general meetings are held in Germany. That is also overseas, right? Its directors live in the UK for most of the year. Now its directors live in UK. Okay, so technically this is the first scenario up until here. From here, there is second scenario. So guys, simply here, see, it is incorporated in UK. Most of its board meetings are held in Germany. So that means all of that is happening outside UK. That means it is incorporated outside UK. It is centrally managed and controlled outside UK. The only thing is that its directors live in UK. Obviously, they'll have to travel for the board meetings to be held in Germany. Right? So technically nothing is taken into consideration for the control in UK. So this is technically directly an overseas company. Okay, because it is neither incorporated in UK nor centrally managed or controlled in UK. Second one, Marble Limited is incorporated in Italy. Okay, it is incorporated overseas. but holds its monthly board meetings in London. That is, its monthly board meetings are held in UK. Other interim board meetings are held in Italy, where some of the directors are based. Most of the directors are based in UK, right? So that means every month they visit UK, right? All of the directors who are outside UK, and most of the directors are any which ways residing in UK, right? Most of the directors are any which ways residing in UK. So technically their monthly board meetings are held in UK. Most of the directors are residing in UK. Only the remainder of the directors who are in Italy, they travel from Italy to UK for attending the board meetings, right? So yes, from Italy, right? Yeah. Okay. So guys, here it is incorporated in Italy, but you can say that it is centrally managed and controlled in UK, and is the reason why this company will also be considered as a resident in UK. Okay. The previous company was not a resident, guys, because in the previous company, it was not incorporated in UK, neither was it centrally controlled and managed in UK. Okay. The second one is going to be a resident. And the third one, Lamb Limited is incorporated in the UK. Board meetings are held in France. Okay. So it is incorporated in UK. It does not matter whether it is centrally managed and controlled in UK or elsewhere. It does not matter. If it's incorporated directly, it will be considered as a resident in UK. Okay. So only the first one was not a resident. The second one and the third one are actually resident companies of UK. Okay, guys. Now let us understand taxable total profits. That for a company, what are the taxable total profits, and thus what is the corporation tax charge on their incomes? Okay, on their profits. Now, guys, a taxable total profit of a company for an accounting period are the total profits from all sources less any qualifying charitable donations. So, guys, any total profits that are there. So, there are a couple of heads like your property income if the company has any property which is given out on rent, the trading income that the company does, and any like interest income. Maybe say the company has had any fixed deposits from which they are receiving interest. So that is an interest income to the company, right? So all these are different sources of income that the company has, and these will be allocated in different heads. Eventually, you will get a total profits, and from those total profits, the QCDs will be deducted, and QCDs are nothing but certain charitable donations which are qualifying in nature. So if they are qualifying charitable donations, those are going to be deducted if in case the company makes such donations to a charity. Okay. A company's total profits are its worldwide income, but always excluding dividends. Dividends that the companies receive are an exempt income. Okay. Dividends received by the company are an exempt income. So worldwide income plus, excluding dividends plus their net chargeable gains. What are net chargeable gains, guys? It is nothing but maybe say I sold two assets. Right now, I'll just give you all a brief explanation of what is chargeable gains. I sold two assets. Okay. In the current year, I sold two assets. One asset had a value of 60,000. Okay. I sold it for 90,000. So when I sold it for 90,000, I got a profit because its value was 60, but I could sell it for 90. So that means 30,000 is my profit, is my gain, right? So whatever gain that I receive on selling of the assets, those are going to be considered as my capital gains. Okay. So capital gains are also going to be taxable under the company's corporation tax. Okay. So always remember, for an individual, if there are any capital gains, it will be taxed under the capital gains tax rules, that is CGT rules. But for a company, if there are any capital gains, it will not be taxable under CGT rules. It will be taxable under corporation tax. So you will add the capital gains as a capital income within the total taxable profits of a company. Okay. So if in case I got a 30,000 gain on the sale of the first asset, the other asset was having a value of 50,000, but I sold it for 38,000. Okay. That means on its sale, I made a loss. Correct? I made a loss of 12,000. So that means what is my total chargeable gain? On one asset, I made a profit. On the other, I made a loss. So loss will be deducted because it is in the same year, in the just from a different asset. So 30,000 minus 12,000. My chargeable gain is going to be 18,000. Okay, my chargeable gain is going to be, guys, 18,000. So that net chargeable gain will be included within the total taxable profits of the company, and on that corporation tax will be paid, not the capital gains tax. Okay. Okay. Now let us look at this format. Through this, you will understand that how you are supposed to actually calculate the total taxable profits of a company and then actually imply the corporation tax on the same. Okay. Now, what is tax adjusted trading profit? Technically, you will be given a statement of profit or loss of the company. Okay. You will be given a statement of profit or loss of the company, and at the end you will be given, after taking into consideration all the profits, and after deducting all the expenses, you will be given a profit for the year. Correct. You will be given a profit for the year. So the tax adjusted trading profit is nothing but you will take that profit first. You will take that profit first and go inverse. Okay. That means whatever are the expenses that are there, whatever are the incomes that are there, which is included within this profit, those will be added and subtracted, or no adjustments will be made depending on whether they are allowable to the company or disallowable. Okay. Like maybe say the company has stated any, okay, I'll not state that. Oh, now maybe tax adjusted trading profit. Maybe the company has stated any property income. Okay. Property income, whatever income is there that the company has stated, that is not a part of the trading profit that they generate. Correct. But that must have been added while calculating the profit of the company. Correct. Because in the P&L they must have stated they have received a rent probably from the property income. So maybe they are actually considering the property income there. But obviously this will not be allowable here because there is a separate head for property income that you will state in a separate head. So in the trading profit, it is the property income is not a part of the trading profits that you generate. So it must have been added here to your incomes, correct? And that is how your profit you must have got, correct? So in order to eliminate that from the tax adjusted trading profit, you will actually deduct this income now. Okay. You will deduct this property income to eliminate its effect from the tax adjusted trading profit. Okay. And that is how many of the incomes that are there, or many of the expenses that are there, which are disallowable or maybe which are allowable, for them you will make certain adjustments. We will solve one comprehensive example where you will get an understanding for each one of them. Okay. Then the next part is interest income. That what is the interest that you are receiving, and how it is to be stated here. Okay. Interest income would be maybe I have made a deposit, or maybe I have purchased certain bonds. Okay. So on those I am receiving interest, correct? So these interest incomes are going to be stated within the head interest income. So if the company provides me the statement of profit or loss, okay, and they will give me a profit at the year end. So profit shall be taken, this profit will be taken, and if in case there is any interest income which is stated here, that will obviously increase my profit, correct? Now, for interest income, it will not be included in the tax adjusted trading profit. So while computing the tax adjusted trading profit, that interest income shall be removed, because for that it will be taxable separately under the head interest income, not under tax adjusted trading profit. Okay. So interest income will be there. Property income is there. Maybe I've given some property on rent or something, or maybe I've given it on lease also. Then miscellaneous income. Miscellaneous income is, guys, any other income which does not fit in any of these heads. Those are known as miscellaneous income, like any premiums that you get on certain premium bond winnings and everything. So these miscellaneous incomes, technically all maybe you get a royalty. Yeah, that will be an example. Royalty on patent or something, right? If you get a royalty on patent or something, it will be stated in your miscellaneous incomes, but they are not examinable, guys. Royalty on patent and everything, that is not examinable for our tax purposes. Chargeable gains, Any sort of chargeable gains, I just explained you what is your chargeable gains. After that, eventually you will get your total profits. From the total taxable profits, from the total profits, you will deduct your QCDs. And after deducting your QCDs, that is technically deducted. Okay. You will get your taxable total profits of the company for the year. That is going to be this. And your corporation tax for the year is 19%. So technically you're going to charge 19% tax on the taxable total profits of the company. It is a slab rate, simple rate. Just you have to charge 19% for the year. Okay. So you can see tax adjusted trading profit I've already explained you. Interest income also I've already explained you. Property income assesses the profit or loss from letting furnished or unfurnished property and is calculated always on accruals basis. Always remember guys, all my interest income that is there, my property income that is there. For an individual, we calculated on a paid basis and a received basis, right? That means we calculated on a cash basis. But my financial statements, my statement of profit or loss, which is provided by a company, they always prepare on an accrual basis, and the tax will also thus be calculated on an accrual basis only. Okay, so always remember it will be on an accrual basis only. So if in case I've paid certain interest during the year 5,000, that doesn't mean I'll take this. Okay, I will check that how much interest is accruing for the year. Okay, how much interest is accruing for the year. Okay, that will be taken as my interest payment. Okay, guys. Then, as I told you, any patent royalties receivable in respect of non-trade related patents would be included here, but they are not examined for our tax examination. Dividends, as I told you guys, dividend incomes that the company is generating, those are exempt while calculation of tax. So if in case there is any dividend income which is added as an income to your tax adjusted trading profit, you will deduct it while calculating the TATP because dividend incomes are not taxable. Okay. Then any chargeable gains and losses. If in case there are any chargeable gains and losses, on that always remember corporation tax is charged of 19% and not the CGT rules are applied. Okay. Now lastly, qualifying charitable donations. Guys, qualifying charitable donations are nothing but, just a second. Yeah. Qualifying charitable donations are nothing but all donations which are made to charity. Okay. All donations which are made to charity by a company except those allowed as a trading expense. Okay, that means there are certain charities that are actually considered as a trading expense. Maybe I'm giving certain maybe I have a product, okay, and I'm giving that product to the customers for free so that they can try the product, and with this my brand value will increase, and maybe my market approach will be increased, my market size will increase, people will know about my product because they are using my product for free, right? Like maybe my product was to give sim cards, so I'm giving sim cards for free, right? The sim cards of the phones, right? So maybe I'm giving it for free to the customers, so they will start to use my sim cards, and then eventually they'll end up using my sim card only, right? So technically it is like a trading expense to me that I'm providing it to them because I have made it, right? It is costing something to me. Correct? I have made it. So it is a trading expense to me. So it will directly be deducted in the tax adjusted trading profit. Then it will not be considered as a QCD. Okay. And if in case the relief is referred to as a QCD that we all know, all charitable donations by a company are paid gross. Okay. That means here they do not get a deduction of HMRC. Whatever is the amount paid, that will be considered as the gross amount. Note that the tax treatment of donations to charity made by a company is different from that. Okay. So the tax treatment for the charity donations which are made by a company, it is different from an individual's charitable donations. Under the gifted scheme, if you remember, it was extending the band, but that does not apply for a company because for a company there are no bands. There is straightway 19% tax. Okay. So charitable donations extension of band relief will not work here. The only relief that they will get if in case they are making charitable donations. Okay. If in case they are making any sort of charitable donations and it is related to their trade, so the expense for these charitable donations will directly be deducted while calculating the tax adjusted trading profit, because obviously it is related to your trade, correct? But if in case any charitable donations are made which is non-trade related, maybe I've contributed to a national charity, then it if it is shown in the profit as a deduction, it will be added back while calculating the tax adjusted trading profit. Not because I cannot get a relief for it, but I will get a relief for it in QCDs. I will separately take it under the head QCDs and deduct it from and deduct the QCDs from the total profits. Okay, guys, is the reason why it is not applicable here. So it will be added back here, that expense, because it is disallowable here, and it will be deducted in QCD calculation. Okay. Okay. Firstly, let us compute the tax liability. Cumberland Limited has the following income and outgoings for the year ended 30th September 2022. He has tax adjusted trading profit 81,500. He has property income of 1300. Interest which is receivable, that only will be considered. Okay. Interest which is receivable, because it is accrual basis that we are supposed to calculate. If there was interest received, then we would have to calculate the amount which is receivable. Okay. Chargeable gains is 3000. So chargeable gains will be added. And dividends from UK companies, this is exempt income. So this will not be added in the total income of the company. So the total income of the company is 81,500 plus 1300 plus 2200 plus 3000, that is 88,000. Right? From this, QCDs will be deducted of 1000 and the remainder 87,000 is going to be my total taxable total profits. Right? So my corporation tax, that is CT, that is 87,000 into 19%, right? So my corporation tax will thus be 87,000 into 19%, which is going to give me a value of 16,530. Okay. I hope start to end it is clear to you guys. If you have any other doubts, you can let me know in the comment section. Okay guys, as I told you, your financial year, that means the rate of corporation tax is fixed by reference to the financial years. Now financial year runs from the 1st April and ends at 31st March. Okay, and is identified by the calendar year in which it begins. So maybe say on 1st April 2023 it started, and the financial year ended on 31st March 2024. That means my financial year can simply be stated on the day when it started. Right? So it started in the year 2023. So this is the financial year 2023. If it would have been started at 2022, this would have been a financial year 2022. Okay. The year commencing 1st April 2022 and ending 31st March 2023 is the financial year 2022, as I already told you. Okay. I hope it is clear, guys. As I told you guys that the corporation tax liability is 19% that is charged, and it has been so for a number of years. Okay. So since 2021, 2020, always it has been 19% for many years. Okay. Okay. Let us compute the income, the corporation tax. TATP is 3,20,000 pounds. Chargeable gains are 10,000. Dividends received from UK companies is 18,000. This will be exempt. So this will be 0. So the total income that I have is 3,30,000 pounds. What is happening? And on this, the corporation tax will be into 19%. That is going to give me 3,30,000 into 19%. That is 62,700 is my tax to be paid. Okay. I hope start to end it is clear, guys. Okay, guys. Accounting period that is straddling. Maybe say for one period, the corporation tax is less than 19%, and for the other period, it is 18%. Sorry, it is 19%. Okay. So when there is a difference between the two financial years, so then the accounting period straddles. Okay. That means maybe my accounting period started on first, maybe it was too old. Okay. I'll just redo this. Yes, maybe my accounting period started on 1st January 2012. Okay, it was too old. So at that time, maybe the corporation tax rates would be different. My accounting period started on 1st January 2012 and ended at 31st December 2012. Okay, now guys, maybe till 31st March 2012, the corporation tax was 18%, and after that period, it began to be applied at 19%. And my total profits for the full year is 8 lakh, maybe. Okay. So my total profits for the full years is 8 lakh. From 1st Jan to 31st March till the date it was applied 18%, I will apply 18% tax and into 3 divided by 12, right? Because obviously only for 3 months I'm supposed to charge. Into 18% into 3 divided by 12, that is going to give me 36,000 tax, right? And for the remaining 9 months it will be 8 lakh into 9 divided by 12, but the tax percentage will be 19%. Okay, so it will be 8 lakh into 9 divided by 12 into 19%, that is going to give me 1 lakh 14,000. So my total tax liability will be 1 lakh 14 plus 36,000, and thus the total tax liability will be 1,50,000. But guys, always remember this is not examinable anywhere because anyhow your corporation tax liability is not changing. It is 19% only for the recent years. So in examination it will be asked nowhere if in case your accounting period is straddling in between. Okay. So technically this is not a part of your portion, you can say. Okay. Now we jump to trading profits, but obviously before that we'll take a short break of 10 minutes and return with the remainder of the chapter. Okay, guys, let's get started. Okay, guys, now we are going to understand how to calculate the tax adjusted trading profit of a company. So, the trading profit, we have also understood it in the chapter for calculation of tax adjusted trading profit for an individual. Right now, we are understanding the tax adjusted trading profit calculation for a company. Okay. We have understood sole traders trading profit for tax purposes. The rules for companies are very similar. There is just certain other adjustments that are required. You have to disallow expenditure which is not wholly exclusively incurred for the purpose of trade. Disallow entertaining, right? Like except entertaining staff. So if you're entertaining staff, like having a Christmas party held for them, or entertaining them by giving them a ticket of a cricket match or a football match, then that is an allowable expense for the company. But if you're actually trying to entertain your clients or your customers or your former employees or anyone, then those are considered as disallowable entertaining. And if in case in the profit that they have given us, right, in the profit that the company has given us, while we take that profit for calculation of tax adjusted trading profit, in that we, if in case the expense is already deducted for entertainment of the clients or the customers, then in that tax adjusted trading profit we are going to add back that expense, because that expense is deducting my profit, correct? In order to disallow it, I will add it back. Okay. And if in case I've incurred certain expenditures for a Christmas party for my staff, that is an allowable expenditure. So while I calculate the tax adjusted trading profit, they will give me a profit, correct? So the profit of the company, in that already the company must have charged this expense, correct? For giving a Christmas party to its customers, sorry, to its employees, right? Now this is an allowable expense and it is already deducted. So that means while calculation of the tax adjusted trading profit, there will be no effect of this expense because it is deducted and it is okay, it is allowable, right? So it's not like I will just completely ignore it. Whenever no adjustment is required, I will just write that expense again, that it is a Christmas party expense or entertaining expense, and I will just write here zero, that it has a nil effect. Okay, because I have to show that all the expenses that have been incurred while calculating the tax adjusted trading profit, that expense is stated, and since it is an allowable expense, it is actually stated as no adjustment, that is zero. Okay. Disallowable expenditures also includes any expenditures on capital items. That means if I've done a capital improvement, maybe there is a building, okay? It is a four floors building, one, two, three, four. I'm extending the building's floor. I'm making a rooftop on it, okay, separately, so that the building's value would increase. So this is an improvement to the building. Okay. So any improvement that I'm doing to the building, it is known as capital expenditures, and capital expenditures are not a part of my trading activities. So if in case there is any capital expenditure that has been incurred by the company, which is deducted in the profits, that will be added back because that is disallowable. And for that, obviously the company gets capital allowances, right? Then adjust any leased high emission cars which has a CO2 emission above 50 grams per kilometer. So technically, if in case that those cars are leased, then in such a case you have to make an adjustment. That means you have to add it back. Okay. Then adjust for gifts to customers. If you are gifting your customers, obviously that will be added back. Disallow any depreciation, because obviously the company gets capital allowances, that WDA, if you remember, that is a form of depreciation that the company has given as an allowable as an allowance, right? So capital allowance is given 18% WDA for the main pool and 6% for the special pool. So guys, obviously they are getting that deduction. So whatever is the depreciation which is charged in the tax adjusted trading profit, that will be added back. Lastly, adjust for profits or losses on disposal of the capital items. So if there is any profit or losses which are there, which is included within the profit, okay, so that profit you have generated by selling off your assets, right? So that is not profit of the trading activities. That is a profit that is known as chargeable gains, right? So that profit will be deducted to disallow it from the tax adjusted trading profit, and it will be included within your capital gains. Okay. Add back any charitable donations in the tax adjusted trading profit, right? In the profit, when they give it to us, they must have deducted any charitable donations, QCDs, right? So if there are any charitable donations, you will add back that charitable donations expense, because it is not deducted in the tax adjust in the trading profits. It should be deducted separately under the head QCDs, right? So in the QCDs you will add it, and eventually from the total profits you will deduct it though from in the name QCDs. Okay, so this expense of charitable donations, if it is a national charitable donation, then it will be considered under QCDs. But if it is a small or local donation, then obviously you can keep it the way it is. You don't need to add it back as an expense because it is a local charitable donation. Okay, then it does not qualify for QCDs, but it is your expense, so it can be deducted. Adjust for non-trading income. All the rules apply for companies. Okay. So adjust for non-trading income, any other incomes which are non-trading related incomes. So if in case they are stated as an income within the P&L, that will be deducted while calculating the tax adjusted trading profit to eliminate, to disallow it, because obviously it will be treated depending on whether it is an interest income or whether it is a property income that they are generating. So accordingly, it will go into their particular heads. Okay. However, there are a number of key differences which apply when computing the taxable trading profits of a company, that is private use adjustment. Now, guys, what happens is, just a second. Now, guys, what happens is the company that has given a car, the company that has given a car to its employee or manager. Okay, so there is a company car which the company has given to the employee or the manager of the company. Now, if in case the manager or the employee is making private use of that car, then the private use will be considered as a taxable benefit for the employee. Okay, it will be taxable, the private use adjustment, right? So we do it in the capital allowances, we state private use separately, right? So for an employee, they are making a private use of it, so they are enjoying the benefit of the company car for their private purposes, and is the reason why that private use will be considered as a separate taxable benefit and will be added back. But for the company, it does not matter whether it is given for private use or it is given for business use. So the company has just given the car to the employee. So the total is an expense to the company, correct? The total is an expense to the company. So for the company, it does not matter that the employee uses for his private use or for the business use at whatever percentage, the total will be allowable because company has incurred the total expense, right? It does not matter then the employee is using for his private use or not. So employee will be taxable on his private use, but the company will not be taxable if in case the employee makes use for private purposes. Okay. Always remember you have to take the interest payable and interest receivable on an accrual basis, and the dividends also that are payable shall be eliminated from the profits. Okay. If in case the dividends which are payable that I'm paying, okay, then dividends payable, actually this will not be eliminated. I'll show you the adjustment for the same. Capital allowances, lastly, you will get special capital allowances for your companies that I'll show you. Okay. Okay. Also, in addition to this, for land and building, if you must have seen chapter number 8, if you must have seen the chapter of capital allowances for individuals, there is something known as SBAs which are given on it, right? Something known as SBAs which are given on it. That is nothing but a straightway 3% deduction on the value of that land and building, right? So the same rules applied for companies, but in addition, the following points should be noted for the companies. That is, technically, for your capital allowances, Firstly, they will get an annual investment allowance of 1 million pounds every year, right? Every 12-month accounting period, they will get 1 million pounds of annual allowance. The AIA amount of 1 million pounds is included in the tax rates. Okay, that is not to be noted. The same which is available for individual is also available for the company, that is up to 1 million pounds. If in case they make a purchase for any asset during the year, for that asset purchase up to 1 million pounds, it is deductible provided that asset is a qualifying asset. Okay. Same goes for the company. Now, always remember guys, your AIA, your WDA and everything will be restricted if in case maybe say I am preparing an 18-month period. Okay. So the first 12 months, okay, will be the first accounting period, and the remainder of the 6 months will be the second accounting period. Okay. So I am getting an AIA for the first 12 months of 1 million pounds. Okay. But in the next accounting period, in the second accounting period, the accounting period is only of 6 months. So then in such a case, the AIA will be restricted and will be time apportioned. That is going to be 1 million pounds into 6 divided by 12. So that means I will only get 5 lakh pounds as my AIA for the second accounting period. Okay. Also same goes with WDA. If in case WDA is 18%, so accordingly you will calculate with WDA. Okay. Now enhanced capital allowances. Now there are certain capital allowances which are provided on certain specific assets which are actually mainly purchased between the year 1st April 2021 to 31st March 2023, and these assets are only plant and machinery, not anything else like cars or anything else is not considered, only on plant and machinery. So any plant and machinery which has been purchased between the period 1st April 2021 to 31st March 2023, they will be eligible to a special claim, that is 130% super deduction for assets which would ordinarily go to the main pool, right? So technically if I purchased an asset for 8 lakh, I will not take AIA on it. Maybe say it was an equipment. So it is my plant and machinery, correct? It was purchased maybe on 1st April 2022. That means it is between this period 1st April 2021 and 31st March 2023. So there is a super deduction which is given on this asset, and that is of 130%. Right? That means 8 lakh into 130%, that will give me 10 lakh 40,000. So the total 8 lakh will be eliminated here. Technically, I will just directly say 10 lakh 40,000 will be deducted here. Obviously, nothing will go to my main pool, and the total allowance that I've got is of 10 lakh 40,000. Okay. How will this 130% benefit me? When I calculate my loss relief, the total loss that is there for the year, it is nothing but the profit that I get for the year, and from that I'll deduct the capital allowances, right? So the capital allowances are 10 lakh 40,000. That means in total I can claim a loss relief of 10 lakh 40,000 of the capital allowances. Okay. Then also there is a 50% first year allowances for special rate pool assets. It mainly includes your assets except for cars. On cars there is no FIA, there is no super deduction. Okay. There is no super deduction, there is no FIA on cars. There is a 50% FIA on certain assets which goes to your special rate pool, like your water heating systems, drainage systems, like your other things like water heating systems, drainage systems. What else is there? Some other details like elevators and something within the escalators and something within the building and everything. So they usually have a useful life of 30-40 years. Okay. So they are used for a very long period of time and is the reason why they are going to your special rate pool. But they get a 50% first year allowance. This 130% super deduction and 50% first year allowance is not given to the individuals. It is only given to companies. Okay. So they get a 50% first year allowance. That means if their total value is 8 lakh, they will get 50% first year allowance of 4 lakh. Okay. And the remainder 4 lakh will go to their special rate pool. Okay. And the allowance will be 4 lakh in the allowance section. Okay. Always remember this. So first year allowance that they will get is nothing but of 4 lakh. But guys, always remember, because in your special rate pool you get 6% WDA only, rather you should claim annual investment allowance on your FY on your special rate pool assets first. Right? So you can claim 50% FYA on that asset and you can claim AIA on that asset so that nothing goes to your special rate pool. All this is done. Yes. So super deduction and your 50%, sorry, your 50% FIA is not given on second-hand assets. It should be only for the newly purchased assets. It should not be given on cars and it should not be given on assets bought in the final accounting period of trading. In the final accounting period of trading, there is nothing given. No AIA, no FIA, no WDA, nothing. Okay. Okay, now let us solve this example. Through this, you will understand that what is the total amount of capital allowances that a company gets. Okay. Spreads Limited, oops. Spreads Limited has an accounting reference date of 31st March. During the year ended 31st March 2023, Spreads Limited purchased a new fixed machinery costing 5 million. Okay. And the new integral features costing 1,50,000 pounds. No, sorry, it is 1.5 million, right? So the balance brought forward on the main pool is nil pounds. You have to calculate the maximum capital allowances that they can claim during the year ended 31st March 2023. Firstly, they have purchased a new fixed machinery. That means it is a plant and machinery and they have purchased on 31st March 2023. So till 31st March 2023, you get a super deduction, right? The value of this machinery is 50 lakh or you can say 5 million. A super deduction of 130% is given on this and obviously there is no limit for super deduction. 50 lakh into 130%, it is going to be nothing but 65 lakh or you can say 6.5 million is the super deduction which is given on this asset. And there are also certain new integral features that are costing 1.5 million. So those integral features of a building, I guess there is, right? Because these are integral features, they do go to your special rate pool. So on that you will get 50% FYA. But guys, firstly use your AIA completely on these integral features. Okay, so these integral features have a value of 15 lakh. AIA is given 10 lakh on them, right? Or you can say 1 million. So technically only the remainder 5 lakh is there. And now you claim FIA on this, that is going to be 50%. So 2,50,000 is the FYA you can claim and the remainder 2,50,000 will go to your special rate pool. Okay. You can see here they've shown you the same calculation. Okay. Now always remember guys that wherever there is a short-term accounting period, then in such a case, the AIA and the WDA are going to be proportionately reduced. They are supposed to be restricted. Okay. And whenever there are long accounting periods, as I told you, the long accounting periods are to be distributed long period of account. They are to be distributed in two accounting periods. One is the first 12 months and the second one will be the remainder of the months. Okay. Private use adjustments also I have told you that private use adjustment no matter what the level of private use adjustment the employee is making, employee will be taxable on that private use adjustment as a separate benefit. But for the employer, it will be, I mean, for the company, it will be totally deducted. Okay. Okay. Now let us solve this sum. Maybe through this sum you will get clarity on capital allowances. But before solving this sum, guys, we'll take a break again of 5 minutes and then return with the remainder of the chapter. Okay, guys, I hope we are back. Let's get started with the remainder of the chapter. Okay, maybe Ellingham Limited is a UK resident company that manufactures aeroplane components. The company has prepared accounts to 31st December in each year and has now to decide to change its account preparation to 31st March after having period accounts to 31st December 2021. So that means they have prepared the accounts from 1st Jan 2021 to 31st December 2021. Now they decide to change this time and keep it 31st March 2021. Okay. So on 1st January 2022, sorry, on 31st March 2020, correct? So on 1st January 2022, the TWDVs of plant and machinery were as follows. Okay. I think it is taking from 2022 to 2022 and here it will be now they are changing to 2023. In the main pool at the start of the year was 149 to 80 was 13,440 in the short life pool. The following assets were purchased during the 15-month period ended 31st March 2023. Okay, so the period started from 1st Jan 2022 and ended at 31st March 2023. So this is a 15-month period. This will be subdivided into two accounting periods. One is from 1st Jan 2022 to 31st December 2022 and the second one is 1st January 2023 to 31st March 2023. Correct, guys? Now, on 11th April, that means during the first 12 months period, they purchased a new heating system. On this, they could get 50% FYA, but first it is rather preferable to deduct the annual investment allowance from your special rate pool assets because obviously it is better off to deduct it from there because there you will get only 6% WDA, whereas on your main pool assets you get higher WDA, right? So you can benefit more from that. On 5th June 2022, that means within the same year, the first 12 months period, they also purchased a new equipment which had a value of 1,800,000. On this new equipment, you can see it is purchased between the time period 1st April 2021 to 31st March 2023. So they will get a super deduction for it. On 22nd September, they purchased a new car which is 39 grams per kilometer. Car which is having 39 grams per kilometer of CO2 emissions, they go to your main pool, correct? And obviously on that you do not get any FYA or AIA until and unless the car has zero CO2 emissions. If the newly purchased car has zero CO2 emission, then it will be considered as your FYA car. Okay, so that means FYA allowance will be given and nothing will be going to your main pool. There is a new van, right? New van is also your plant and machinery. So it will be considered at 130% super deduction. New car is purchased with zero CO2 emissions. You will get FIA total amount. There is no limit of FIA. 12,200 pounds totally will be eliminated by the allowance and there is nothing to be taxable on it. So nothing will go to your main pool regarding this car. Okay. Ellingham Limited made the following sales. So that means they sold an asset on 15th August during the year. They sold a lorry for 14,160 and they sold the short life asset that was there for 5,520. Right. At the start of the year, the short life asset had a main pool balance of 13,440. Okay. The lorry was sold for 14,160 pounds which originally had a cost of 21,600 pounds. You have to compute the capital allowances for the 15-month period ended 31st March 2023. So let's get started, guys. Firstly, I have my main pool. I have my special rate pool. I'll write SRP. I have my short life asset. Then I have all my allowances. Okay. I have all my allowances in the end. Now, guys, focus here. Firstly, I purchased, okay, firstly I'll state the TWDV, that is the tax written down value of my assets which are brought forward. So in the main pool, the TWDA, is it right? Where is that? Yeah, the TWDV zone. Yeah. So the TWDV for the main pool, it is 149 to 80. For the short life asset, it is 13,440. 149, how much was it? 280, 13,440. 280, and in the short life asset it is 13,440. Right? Now, the next part is, firstly I'll do it for the year ended 31st December 2022, correct? Because I have to distribute it in two accounting periods, right? Now, the first thing that I purchased is a new water heating system for 12,800, right? I purchased a new water heating system for 12,800. So, firstly, I'll account for this. Okay. Okay. So, the new water heating system has a cost of 12,800. I'll also add £1 section. Okay. So it has a cost of 12,800, but I will give AIA first to it because it goes to your special rate pool. So rather I would save it from going to your special rate pool. Okay. So AIA I will give, my AIA for the year is 1 million, and obviously this is lower than 1 million. So the whole thing will be taken, and in my allowances I will write 12,800. So nothing will go to my special rate pool. Okay. Then the next part is new equipment that I bought for 1,800,000 something, right? For 10 lakh 800. New equipment 10 lakh 800 is its value, and obviously I will get a super deduction of 130%, which is going to be 10 lakh 800 into 130%. That will give me 13040 something, and that will be my allowance also, right? So my allowances will be added here, and obviously nothing will be going to my main pool. Then I purchased a new car for 11,760 with 39 grams per kilometer CO2 emissions. New car, 39 grams per kilometer CO2 emission. It will directly go to my main pool because it is 39 grams per kilometer. Okay. 11,760. Then I have a new van that is 7,200. Its value is 7,200. Yes. And obviously from this I will get a super deduction of 130%. So that will be 7,200 into 130%. Correct? That will be 9,360. Correct, guys? So it will be taken here as an allowance. Right, guys? 9,360 will be taken here as an allowance. Yeah. So 9,360 is the allowance that I got, super deduction for the new van that I purchased. Then there is a new car with zero CO2 emissions. New car with zero CO2 emissions. Grams per kilometer. Right? So if it is a new car purchase, you will get a first year allowance on this car. Totally will be eliminated. Right? And its value is 12,200. So 12,200 total will be deducted. and will be stated here in my allowances. Right? Lastly, I have the sale of certain assets. So firstly, I'll just do the total of all of this. Yes. So it is 161,040 in the main pool, 13,440 in the short life asset pool, and the total allowances that has been taken till date is 1.3 million something. Right? Now guys, lastly, I have sold a lorry, right? The lorry was sold for 14,160 pounds, and its original cost was greater than it. So obviously we take the lower of these two, and obviously it will be 14,160 pounds. So that will be deducted from the main pool, 14,160. Then I also sold a short life asset for 5520 for 5520. So actually, I should have not taken the total here. Directly, I should have taken the total. I'll just delete this here. So I sold all this. Now I'll check the main pool balance. That is 146,880, and here it is going to be 7920. This is going to be my total. Okay. Yeah. Okay, fine. Now, lastly, guys, we have something to be taken into consideration. That is our WDA. WDA in the main pool will be given at 18%. So it will simply be 14 lakh 6, sorry, it is how much? 1 lakh 46 something into 18% will be my WDA given on it. So that will be 26438. And here I will not give a WDA of 6% or anything. Technically, in my short life asset, I had that asset and I sold that asset. The remaining balance is still there. I don't know for what reason, because I sold it, correct? So on the remaining balance, I give a balancing allowance of the total amount, because there is nothing right relating to the short life asset. It is completely sold. So then technically 7920 is the balancing allowance that I got separately, and this is the WDA that I got on the sale of the asset, that is that lorry on the main pool. Right? So sorry, it is relating to the 18% WDA for the remainder on my main pool. Right? So I am done with everything for the year ended 31st December 2022, and I will just take the balances of my main pool now to the next year, which is 120,441.6, and here it will be 0 and 0, and the total balance here is going to be 1,369,758. Okay, so these are the total allowances that I have got for the year ended 31st December 2022. Right now, for the 3 months period, I have purchased nothing during the 3 months period. So whatever is the balance on my main pool, that I'll take directly, and obviously I'll give WDA on it 18%. So 18% WDA will be given, and that will be the only allowance for that period. Okay. But guys, always remember the WDA of 18% is going to be time apportioned, because it is just a 3 month period, correct? So it will be 3 divided by 12. Only that is the WDA that I will get, and the amount of allowance. Okay, I think the amount is calculated wrongfully. Just give me 1 second. Technically, my WDA will be 18% into 3 divided by 12. So 18 into 3 divided by 12. I will get a deduction only for 4.5%. So into 4.5. 5%. So this is the only deduction that I will get, and eventually I'll have my balance at the second year also. Okay. So I hope guys this sum is clear to you all start to end. Now in the remainder of the chapter, there is just a couple of sums. We do not need to go through each and everything in this chapter. We'll just do a full-fledged sum that you'll understand in the next class. Okay. So guys, with this, our today's class comes to an end. This was the only part that was to be covered for today's class. We meet in the next class wherein we are going to be covering the remainder of the part that is going to be our our loss relief calculation, and also the remainder of this chapter. One or two comprehensive examples will be solved to make you understand after completing the remainder of this chapter a little bit. Okay. So thank you guys for your time and efforts. We meet in the next